So today we want to give people some strategies, some things that they can consider, talk to their retirement planner about, be thinking about, because you don't have to be necessarily a victim to some of these economic conditions that you're seeing around you. So the first one, Haley, is rebalancing your 401k. What does that look like?
Yeah, so this is if you're still working and you're putting money away within a 401k plan. So this is for your existing allocations underneath the 401k. And as a reminder, the 401k is very limited on the options that you have. Primarily, you're going to have some stock options, some bond options, and then maybe a stable value or money market fund. And the issue that we're seeing with bonds is it's an interesting topic because right now with the interest rate environment that we're in, bond prices are going down. Year to date, bonds have been down anywhere between 12 and 20%. So if we have a high level of confidence that bonds are going to continue to lose money over time, what can we do with this portion of our 401k to take advantage of the environment that we're in? And one thing is we can get out of bonds. But if we get out of bonds, we have to put that somewhere else. So if your 401k plan has a stable value fund, that is a way that you can hedge yourself against the downside risk of stocks, but then also get a reasonable rate of return that's offering you more than what the banks are, maybe somewhere over 2%. But again, this is just a strategy. It doesn't work for everyone, so make sure this works out in your plan.
Yes, so go ahead, Lauren. I would say if you're watching this at home, you like this idea, how does this execute inside a 401k?
Yeah, really there's a couple different ways you can execute what you just talked about, Haley. One is you can call your custodian. So wherever your money is housed, you can call them, you can tell them exactly what you want to do. They can facilitate that for you, or you can log online and you can go through the different prompts that they offer you through the online system and get it done that way. But you said it really well. Any of these strategies that we talk about here today are not strategies for everybody. They may not work for you. They may not be the best for you. And before you do anything, make sure you construct your retirement plan that has your income plan, your tax plan, your healthcare plan, your investment plan, as well as your legacy plan, all built, because the decisions you make with your investments could have a direct impact on what you're trying to do from an income deliverance standpoint, taxation standpoint. All these things are interrelated. So what's good for one doesn't necessarily mean it's good for you. We need to make sure that plan is built first.
So another thing to consider is doing something different with your new contributions. Again, we're talking about the 401k.
Yes, and let's clarify, because what I was talking about previously was for your existing money in the 401k plan. For your new contributions, that's new money going into your 401k. So every time you get a paycheck, a portion of that paycheck is going to get invested into whatever you're allocated in within the 401k plan. And right now, when the market is down between 20-30%, that is a 20 to 30% discount that you could take advantage of with those new contributions. So it would be our recommendation that you get aggressive with that if you have the appetite, because if you can take advantage of that discount in the market and then ride that upswing when it recovers, that's gonna fare you really, really well.
Which seems really contrary to what most people are thinking right now, because every time you turn on the TV, it sounds like it's kind of a doomsday scenario. We don't know how bad it's going to get, but that happens every single recession we go through. The worst part about these bear markets or the recessions is nobody knows how bad this is going to get. But what we do know is if we have a 30% discount right now, and you put your money into stocks in a very strategic way, and if the drop goes down to 40, well, yeah, you lost 10% or so on that contribution, but then you get all of that gain on the way back. And with that strategy that you outlined, it can work really well for some people, because the maximum amount that you can put into your 401k plan on an annual basis, if you're 50 or older, is $27,000. So if you have $1 million retirement portfolio, we're talking about $27,000 that you're systematically putting into a discounted stock market, which can work really well for you when we come out of it, and it shouldn't increase your overall risk in your portfolio that much. Thank you for watching this clip of Retiring Today, and don't forget to subscribe. If you have questions about your retirement plan, take advantage of the complimentary 15-minute retirement checkup phone call.